In this video, I'm going to look at Facebook or Meta. Facebook just released their earnings report. We're going to understand why the stock is down so much. And then I'm going to try to come up with a fair value of the Facebook stock using Phil Town's sticker price. So let's get started. Facebook is down around 20% on the February 3rd at pre-market. Facebook just released their earnings report. And this report, they showed that the revenue for fourth quarter of 2021 is growing as expected. But on the first quarter of 2022, management is expecting to grow only 3 to 11%. So that is a significant decrease in growth. Why Facebook isn't growing so much? Apple recently changed their privacy settings. That was a huge blow for Facebook. Facebook writes that because of the high inflation, they cannot receive as much revenue from advertising. Facebook isn't growing in the United States and Canada so much. Second reason is that Facebook is spending around $10 billion each year on Meta. It will take a lot of years before we can see the results of this investment. And the third reason, capital expenditures are extremely high. These are the main reasons why Facebook is down so much. These are the signs of maturing company: slower growth, larger capital expenditures. Okay, so considering the recent developments, let's try to come up with a fair value of Meta or Facebook stock. To start, we should determine the growth of the company. Book value per share was growing around more than 20% in recent years. So according to Buffett, book value per share is a very good indicator of the future stock performance. So more than 20% book value per share grew each year. We can see that return on assets was also around 20%. Around 20%, I would say, but the Facebook growth is slowing down. Analysts were expecting around 20%. So I believe that the growth will be much slower. What we're going to do is we're going to see the best case scenario and the worst case scenario. The best case scenario, I assume that the growth will be 15%. So that is a little bit conservative, but considering the recent developments, this is the best case scenario. Okay, best case scenario. Growth rate of around 15% would take current earnings per share, which is $13.77. In this case, we get the sticker price of $4.96. After adjusting for debt, we get the sticker price of $5.12. Facebook has more cash than debt. That wise net debt adjusted value is higher. And we get the current price of $5.12 per share. That implies around 100% upside. Also, I use 10% of required rate of return. So in the best case scenario, we will double our money after inflation in 10 years. If we take the worst case scenario, I take only 7% growth, which is extremely conservative. I believe the growth will be much higher. But if we take 7%, we get net debt adjusted value of $257, which is approximately where the stock is trading right now. I use also the required rate of return of around 10%. Okay, to summarize things up, to determine the future value of Facebook stock, we should consider the growth. It all depends on the growth. If we take 15%, we get 100% upside, considering that we have 10% required rate of return. If we take growth of 7%, which I believe extremely conservative, we get that the Facebook is trading around its fair value. What I'm going to do is that I already have a quarter of the position that I want. I bought it around 300. I see a strong support at 220, and I will considerably add to my position at this level. I use fundamental analysis 90%, but the point of entry, I'll try to use technical analysis. Thank you for watching. If you find this type of content useful, please subscribe and see you in the next video.